Hey guys, Kai here with Pure Investments. Today we're going to be covering charting divergences. So a divergence is basically a indicator on a chart where you're using an oscillator and your price action and seeing if they move in different directions, in a sense. There's two primary types of divergences. You have your classic divergence and your hidden divergence, each of which has a bullish and bearish situation to it. So let's break into those. First, we're going to start with classic divergence. Classic divergence is a reversal signal, meaning at the bottom of a downtrend, if you see a bullish divergence, it's a bullish move. At the top of an uptrend, you'll see bearish divergence, meaning a bearish move. So the opposite, basically. If you've been moving up and you're up 20% and you see bearish divergence, that's going to be your reversal signal, right? And same thing with bottom of a downtrend. So what does classic divergence look like for bullishness, right? You have price lower lows, oscillator higher lows. So as you can see here, price is up here, down here, down here, lower lows the whole way down. And if you look at the oscillator though, you see here, 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 the oscillator continued to move up. And this is utilizing Stoch RSI. I'll cover the indications that you can use later. But this is Stoch RSI right here. But in a gist though, you kind of get the idea, right? Lower lows on price, higher lows on the oscillator. This is bullish divergence, and you can see coming off this downtrend, the reversal, and the move up here, that corresponding move that we had, confirming this. Okay, so the other form is going to be your classic bearish divergence. So bearish divergence is basically the opposite of bullish. You have higher highs on price and lower highs on the oscillator. Same thing here. You can see this move up, high here, a little bit of a correction, higher high here, and the move down. Why? Because you had this bearish divergence sitting here. You could see MACD right here. MACD right here, it made that slight little downtrend, slightly lower highs, and that indicated the reversal signal. So uptrend, higher highs, downtrend started because of the reversal signal indicated by the bearish divergence. Your next one, your hidden divergence. So hidden divergence is the basic complete opposite. It's a continuation signal. So as opposed to a reversal signal, you'll see this in a continuing pattern. So if you've been in an uptrend, your bearish or your bullish divergence will be at the top of that uptrend. If you've been in a downtrend, your bearish divergence will be at the bottom of that downtrend. All right, so what do these look like? So your hidden bullish divergence is going to be price higher lows and oscillator lower lows. So we can see here, this is Bitcoin. It made a nice stiff move up, low, 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 higher each way up. Oscillator down here using MACD. This is the low, the low, the low, the low, boom, right? And the move upward continued the pattern. So as you can see again, higher lows, lower lows, continued that hidden bullish divergence and made the move upward. Now you've got hidden bearish divergence. So bearish divergence is, again, the opposite. So you have price lower highs and oscillator higher highs. Now you can see here, I didn't crop the whole chart, but there is a downtrend that this is in, that this comes off of. So this is a continuation rather. So you can see here though, your high here, lower highs, oscillator high here, higher highs on the oscillator. And what did we do? We continued that bearish trend that we had been in, and we continually pushed down. So that's about it with your divergence signals. They're not super difficult. They're pretty easy to identify, and they're incredibly powerful. They're going to be a lot more reliable than things like, say, regular patterns you're going to draw, like head and shoulders or cup and handles or anything of that nature. Just in general, they're stronger patterns because they are formed naturally through price action, right? And that's why you primarily use oscillators and money flow indicators to find them. So what indicators do you use for divergence? Basically 6 primary ones. Your 2 best are going to be Stoch RSI and MACD. Those are going to be your most reliable. However, you can also use standard RSI, CMF, MFI, and accumulation distribution. All 6 of those will do the trick. There's a lot of other indicators that I see people using for divergence, and I don't recommend them. I would definitely stick to those 6. And that's about it, guys. I hope this was short and to the point. You know, it's not a super advanced concept. It is a little bit hard to, you know, get a memory going of what each one is because they are so similar. But you can always look back to this video. And that's about it. I hope you guys enjoyed this video, and I'll see you next time.